And welcome everyone to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. We have a great show for you tonight. I want to thank you very much for being here. Before we dive into the show, I want to remind everybody, if you don't get the show in your city, you can go to GaryK.com. You can listen live or archive 24/7 on any device you want for free, anywhere you are in the world, as long as you have Wi-Fi. Or you can even download it and listen later. So it's available anywhere you want. All of that's on GaryK.com. You can also follow Gary on Twitter, or X, formerly known as Twitter, by just clicking the big button on GaryK.com, or going to Twitter and searching up at Gary Kulpbaum. You get it there. Or if you want to email Gary, ask about his money management services, get subscribed to get his morning notes sent directly to your inbox, you can do all of that on GaryK.com. Now, if you want more, you can go to convictionleaders.com and sign up to Gary's premium service, where he shares multiple updates all day, every day with members, gives actionable ideas, daily webcasts, shows charts, and a lot more. You can actually see what Gary's saying, because here we listen to Gary on the radio, but with Conviction Leaders, you can actually see it. So it's really powerful. Pre-market reports, during the day updates, after the close webcasts, sometimes during the day webcasts as well, weekend webcasts, so on and so forth, all available at convictionleaders.com. All right. So a few topics I want to cover today. I get asked a lot for some just best practices when it comes to investing. And I want to spend some time going through that, because it's really, really important to have structure. And structure, the beauty of it, you can define it any way you want. So when you're investing, before you dive in, and this will be a general conversation today, because there's some important lessons that just work, and it's important things for people to know. So, all right. And it'll help with it's like building blocks. It'll help with everything else. So again, having structure. I wrote a book. It's called Psychological Analysis. If you don't know, you can get it on Amazon. It was #1 on Amazon every day for 3 months. The idea there, high level, is teach people how to make rational, not emotional decisions with their money. Again, it's called psychological analysis. The two big schools of thought on Wall Street right now are fundamental and technical analysis. Well, for years, decades, I was studying fundamental and technical analysis. Fundamental analysis, you study the company. Is the company a good company? Earnings growing, revenue growing, is the valuation, PE ratios, so on and so forth. Technical analysis, you study the stock. And for years, I would view these folks as like they're butting heads. The fundamental people wouldn't like the technicians, and so, technical people, and so on and so forth, and vice versa. Then I came across, this was early in my journey, then I came across Bill O'Neill from Investors Business Daily, which you've heard Gary mention many, many times. Actually, thanks to Gary. And Bill O'Neill's genius was combining both. He took the good from the fundamentals, good from the technicals, and he built his Cancelam investment system and had a great, he wrote a book called How to Make Money in Stocks, and had a great just career. He passed away recently, a few years ago, but had a great career for decades and decades and decades. Is arguably one of the greatest growth investors in history. Okay, great. So I studied it, took his classes. I met him, Bill. I met his son, Scott. I went through the whole programs, all the different things. And young whippersnapper back, this is decades ago, I was like, all right, great, I'm going to get it. And then I would realize I got invited to speak at different groups around the country that would, talk about markets. And very few people were out there beating the market consistently. But there were some people that would consistently beat the market. And I'm asking myself, I'm like, what are these folks doing different than everybody else? There's got to be something. You get Buffett can't have a 50, 60-year track record of beating the market or just having phenomenal returns decade over decade and be lucky. Paul Tudor Jones, Bill O'Neill, Steve Cohen, the guy who bought the Mets recently. All of these folks are self-made multi-billionaires, literally from investing. And they have phenomenal track records. I mean, phenomenal. You don't get lucky. You can't tell me it's a random walk down Wall Street, which is a popular theory saying, oh, yeah, results are random, or the efficient market hypothesis, markets are efficient. Maybe people believe in that. Sure, great. I just don't understand it. I'm a very simple, logical guy. How could Buffett beat the market for decades or just have phenomenal returns for decades and all these other folks I just mentioned, and the market be random or efficient market, meaning there's no way to generate alpha, no way to make excess returns in the market? Doesn't make sense when people do it. So, okay, I had to learn all that stuff and I had to unlearn all that stuff. And then I was like, all right, go back to the drawing board. This is back in the early 2000s. I jumped on a plane. I went to Library of Congress in Washington, D.C. because There were books that were out of print. This is before Google and AI wasn't around, and Facebook wasn't even around when I was doing this. Google was around, but it was in the really early stages of Google. There was Excite.com and Ask Jeeves and all this other stuff, but the information wasn't prevalent like today. So I jumped on a plane, went to Washington, D.C., and Library of Congress, read Bill O'Neill's book, the model books of the greatest stocks in history that was no longer in print. And I read so many other ones too, books from like 100 years ago about trading, investing, and so on and so forth, and success and all this fun stuff, and multiple trips to the Library of Congress. Finally, it dawned on me after years and years and years. It's like, oh, there's a missing element. And that's where I came up with the concept of psychological analysis, my little contribution to investing in Wall Street, or my contribution, not little contribution, but my contribution to investing. And the idea is like, what are these folks doing that consistently beat the market for decades that the other folks aren't doing? Simple. They have structure. They're disciplined. They have an approach which takes the emotion out of investing. So when the market goes up a lot or goes down a lot, they're cool as ice. Maybe they yell and they scream and they go, da-da. Maybe. I don't know. I'm not in those offices with those folks. But what I know is that they stand the test of time. Someone who used to work close to Steve Cohen, the guy who bought the Mets, self-made multi-billionaire from trading, told me the guy doesn't even want the phone to ring. He sits in the middle of a room, bunch of other traders all around him, and his phones just light up. They don't even ring. It's that quiet. So it's like peace, that state of like Zen or whatever word you want to use, where that's the environment he created that works for him. Maybe phones ring in there. I don't know. It's hearsay. I don't have any proof. I've never been in that guy's office, so take it for what it's worth. It's just what someone had said who did work in that guy's office. But again, I have no way to substantiate that claim, but that's just what I'm told. But I believe it because I get it. When you at that level of mastery, you don't want distractions. Ding, 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 boom, boom, boom. Then a phone rings. It's serenity now, like Seinfeld's, right? Serenity now. Peace, quiet. You're in that zone. You're in that state of flow. So when you're bombarded with data, information all day long, and the market goes up, market goes down, most people are staring at their P&L all day long, their profit and their loss, their statements, their account. I made money, I'm up $1, I'm down $1, several zeros afterwards. And that distorts their ability to make rational decisions. It's like a doctor. Imagine a surgeon is performing surgery on somebody, and they're literally looking at their bank statement saying, oh, I just made $1,000 for making this incision, or I made $2,000 for filling this cavity, or made this whatever they want. They wouldn't be a good doctor. They'd probably be fired. But with trading and investing, most people, amateurs or beginners or even professionals, get stuck and get caught up in their head staring at the numbers. Oh, I'm down this much. I'm up this much. I remember years ago, I was in an office and the Dow was at 18,000. Okay, Dow was at 18,000. This is years and years and years and years and years ago. And it was in a bear market, and the market had fallen a lot, whatever it was. And some guy goes in the room. He was a big money manager. And I got into the bathroom, and I just hear this guy like vomiting. I'm like, what is this guy doing? And he comes out, and I saw him afterwards, and I'm like, you okay? And this guy, he just got knocked out. He left the business, and he never came back. And all it was like a down period in the market. A little bit, few weeks. It wasn't even that bad. It wasn't like it was a crazy 2008 bear market or 1999 to 2000, March of 2000 .com crash, which I traded through both of those events. The guy couldn't handle it. And I've seen many folks leave this business, many get knocked out because they put so much pressure on themselves. They think they're the most important thing in the world. That, whatever's going on in their mind's eye is just, blah, blah, blah. It's almost like a distorted view of actuality, of what's actually happening. Learning how to just create structure for yourself and processing the data that comes in all day, every day, filtering out the noise, focusing on the highest ROI data, the highest, most beneficial data points that actually matter is a superpower. Having the discipline, notice, not the motivation, the discipline to show up day in, day out, day in, day out, and do the work, again, superpower, at least in my humble opinion. So Those are some of the things with psychological analysis. It's teaching people how to make rational, not emotional decisions with their money. It teaches people how to get out of their head. Tony Robbins and Jim Rohn have a great line. If you stay in your head, you're dead. Not literally dead, but you got to get out of your head. Think, obviously. And I'm not saying don't think, but understand it's another one of those, like Ray Dalio talks about. We're humans. And have those stops in place and risk, which I'll get to in a few minutes here, and all that to take care of things. All right, up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience on any device you want, anytime you want, all for free on GaryK.com. I know I tend to speak fast, so I have a lot to say in so little time. So if you want to rewind it, fast forward, pause it, take notes, by all means, I strongly recommend it. As long as you're in a safe place, not driving, and you can pause and rewind as you want. So all available on GaryK.com. All right, we spoke about structure. Think about this: if somebody's in a performance business, I'm an athlete, I'm an actor, whatever. There's lots of ways of performing in the world and getting paid for it as careers. Investing is the same thing. It's a performance-based business, right? Someone who's an athlete, use Michael Jordan, for example, would be so disciplined. He'd wake up in the morning at 4 or 5 a.m. every day, go to the gym for hours, shoot the ball. Tiger Woods one time was golfing and somebody said, I wish I'm as good as you. He gets up in the guy's face and he's like, show me your hands. The guy's like, what? He shows him his hands. He's like, no, you don't. If you want to be good as me, you'd have calluses on your hand. You wake up in the morning, you'd swing the golf club until your hands would bleed. And the guy obviously in the crowd didn't expect that, didn't know that, but then that's, doing the work, right? Disciplined. Discipline is a superpower. So being in a performance-based business like this business, having the discipline to show up and do the work and having the structure in place is a superpower. And it's one of the things that separates the very successful people in this business from everybody else. Look at Gary. He's got the discipline to show up every day and do this radio show. Every day and look at the market. Every day invest in the market. That is a superpower. It's not a motivational question. It's discipline. So again, think of two people. One has a discipline, Michael Jordan, to wake up and do the training and do what's necessary to improve and learn and study and da-da-da-da. The other person just goes to the gym whenever they feel like it and they hope they're going to become a superstar. Just based on odds, who do you think would be more successful? The person that has the discipline, shows up and does the work, especially when they don't want to, or the person who relies on just winging it and doing it, whenever they feel like it? I don't know about you, but my money's on the guy, the gal, who's got the discipline and has the structure to show up, even when they don't want to. And that's also a superpower. So having structure in the market, let's talk about that. Well, okay, Adam, I get it. We want to have structure. What does that look like? Well, it all starts with how we process information. The world is a very noisy place. Wall Street is a very noisy place. It's full of distractions. It's so easy to get, like my friend Andy says, lost in the sauce. Oh, this happened, that happened, this guy said that guy said this. Most of that information, absolutely irrelevant. Well, what's relevant? Two things: risk and reward. What do you mean, Adam? Here you go. Creating structure, the beauty here is you're free to do it any way you want. I started before I spoke about the book, Psychological Analysis, saying in the book, there's an infinite number of ways to make money in the market. Your job is to find one that works for you. That's one of my sayings in the book. And how I started this whole speech about, or this, sharing with you what I've learned about some of these timeless lessons and having structure. So if there's so many ways to make money in the market, okay, great. Your job is to find one that works for you. That's the beauty of it. You're free to come up with whatever structure you want. How long or how short, you're up. You're free to do whatever works for you. To figure out a process that's repeatable, that works over the decades, not just weeks or months. It's a never-ending game. It's an infinite game. And make sure you can have the endurance to show up and win and continue doing that work. So that's the structure. That's a discipline. The risk reward. Let's talk about that. I have a podcast called Smart Money Circle. I interview, the smart money. I separate that to big money managers and CEOs of publicly traded companies for timeless advice. It's free. You can click on Smart Money Circle on .com or go to search it on YouTube or Spotify. SiriusXM just picked up the show, so it's available anywhere. And the whole idea is to get timeless advice from the smart money. But what I do, I just passed $1 trillion in AUM on the show. All right. So I've interviewed lots of people, hundreds and hundreds of episodes. And what's become very, very clear is that winners win, and it's not an accident. It's by design. It's by consistency. It's what they do day in, day out, day in, day out. It's like going to the gym. What's better, the guy who's going to go to the gym and just hit it really hard for one day, or the person who's going to go there 4 or 5 times a week, every week for the rest of their life, and do moderate workout or a light workout? Consistency is huge. That's a winning formula, stacking the odds of success in your favor. So what do we mean by all this? When you look at markets, how do you interpret all of the incoming data? So one of the guests on my show told me, he goes, Adam, you're not buying and selling a stock. I go, what do you mean? He goes, you're buying and selling risk. And I thought that was absolutely brilliant. I mean, brilliant. And he's right. He's absolutely right. We're not buying and selling a stock. At face value you are, but go deeper. You're buying and selling risk. You're risking your money for the anticipation of a potential reward at some point in the future, which is unknown. Unknown if you can have a reward to begin with, the size of the reward, so on and so forth. So, okay, if we don't know the reward side of it, what can we control? The risk side of it. Another common theme that I've noticed with successful traders and investors is they are very disciplined with keeping their losses small or cutting their losses. Very disciplined. Why? It's just math. And I spoke about this before. If you've heard this before, I'll go quickly. If you're down 10% on anything, you buy something, it goes down 10% in value, you need an 11% gain to get back to even. If it goes down 25%, you need a 33% gain to get back to even. If it goes down 50%, you need a 100% gain to get back to even. Math on the way down, it's not linear on a percent basis, meaning I'm down 50%. I buy something at 100. It goes to 50. I just lost 50%. Well, all right, to get back up to 100, it's now at 50. It's got to go up $50, which is 100% of 50. But I only lost 50%. Just the way math works. Don't take my word for it. Google it, ChatGPT it, have fun with it. But it's so powerful because it's exponential on the downside. So if you're down 70, 80, 90%, you don't need 80, 90% to get back to even. You need hundreds of percentage points to get back to even, if not thousands, depending on how far down you go. And that's why keeping your losses small becomes a superpower when you can really peel back the onion and focus on what really moves the needle. Risk, reward. Every single decision in my mind's eye is an element of risk, element of reward. Should I cross the street? Should I do this? Should I do that? So on and so forth. And once you look at things that way, from that perspective, and filter out the noise, all of a sudden you get freedom, you get clarity. You get the ability to see things that really matter and filter out the noise. Up next, got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us and missed any part of the show, you can go to GaryK.com. You can rewind, fast forward at your leisure anytime you want. GaryK.com, all for free. And you can subscribe to Gary's Morning Notes. You can follow Gary on X, formerly known as Twitter. Email Gary about his money management services, and do a lot more, all available at GaryK.com. All right. We spoke about structure. Spoke about risk reward. Spoke about discipline, how it beats motivation just about every single time. Now I want to speak about price and volume. Okay, let's go. I get it out. It makes sense. Let's have structure. So my structure, I like to look at markets when markets are closed, especially on the weekend. That to me is a superpower. Markets are closed Friday afternoon, Friday evening. Great. I'll do my weekend work and I'll be free all weekend. Some people wait until Sunday to do it. Whenever you want to do it. Some people do it every day. Before the open, after the open. I like to see what's happening, especially when the markets are closed. So I write a pre-market report. After the close, I want to see what stocks are up the most on volume. I want to see what stocks are leading, what stocks are lagging, what sectors are leading, what sectors are lagging. I'm a big performance guy. How I determine, make sense of the information and filter out the noise? It's price. Is primary in my world. Price is king. Everything else follows. Why? Because what's the one thing that shows up on all of our statements? Price. The one single variable that determines whether or not you make money is the difference between your entry price and where the market price is. That's it. Everything else, including earnings and including news and headlines and economic data and this data and backseat. Even volume, even earnings, even sales, even PE ratios and all this other stuff. Price is the only thing that shows up on my statement that directly determines my performance. All right, I'm going to focus on price. That was a huge liberating factor for me. Volume too, but price is primary. Okay, great. So when price goes down, is that necessarily a bad thing? Well, not really. It's all relative. If the market just had a huge move up, let's say it goes up to 10, 20, 30% or whatever, and then it pulls back 4 or 5%, that's not a bad thing. It's normal. It's healthy. It's the way the market behaves. Once I understood that, it took the fear. Notice what I'm about to go into now is going to be the emotions. The two biggest emotions that impact almost all of our decisions, consciously or unconsciously, are fear and greed. Right? You've heard this before from other folks. It's just what the two biggest variables from an emotional standpoint that impact our decisions in the market is fear and greed. Okay, great. What does that mean? I'm fearful that the market's going to go down. I'm going to lose money. And then when it goes up, I get greedy. That's just how life works for most humans, right? All right. So price, when I understand that variable, if price goes straight down below my entry price and below and just go and break support and does it on volume, then obviously that's not a quote unquote good thing. But if it's a huge move up and then it pulls back a little bit, yeah, that's healthy. It's normal. It happens. So again, understanding the context is super important. So when I analyze things, I want to sort by percent change on a given day, on a given week, month, quarter, year. I like to look at year-to-date percent changes. That just works for me the best. But during the day, I'll look at a percent change on a daily basis. And then I want to make sure I understand the risk and reward. Now start connecting the dots, everything we spoke about, right? Connect those dots. So during the day, I want to find those leaders. What stocks are up the most? Price first, ideally on heavy volume, volume second, and sort it by price percent change. And then just because the stock's up, just like it's because it's down, doesn't mean it's a good thing or a bad thing. No, what's the context? Is the stock moving sideways for 6 months, building a base between, let's say, 50 and 60? Every time it gets near 60, it goes down. Then it gets to 50 and it rallies. That's a base. 60 would be resistance. Think of like a ceiling. And 50 would be a floor. Support is the word. So support and resistance. Other concepts I'm introducing. Again, if this is simple for you, bear with me because it's building blocks. So just because the stock goes up, well, where is it with relationship to support and resistance? Now, if you're going sideways for 6 months between 50 and 60, and all of a sudden one day it starts tightening up, volatility contracts, stock goes really tight, 58, 59, 58, 59, 58, 59, then it stays 59 for a few weeks, and then all of a sudden one day, and there's a catalyst, it goes above 60 and does it on heavy volume. Like Gary says, that's not Aunt Mary and Uncle Bob doing the buying. That's the big institutions. Well, all of a sudden, that's called a breakout. And that, folks, becomes very powerful. Now, not all breakouts work. Doesn't mean the stock's going to double or triple. But if the stock goes to 100, it has to get above 60. It has to break out in order for it to double or triple or quadruple, especially if you can identify that a stock is basing. So after it breaks out at 60, it's binary. Either the breakout fails and it rolls back over, or the breakout works and the stock continues to rally. Now, you could say there's a third one where it just kind of goes sideways for a little bit right near 60, but I'm going to talk about up or down. right? You want to throw sideways in there, throw it in there, no problem. So if it goes up big, now all of a sudden has a big run, it's up 10% or 20%, it's now extended. What should happen there is either build a new base or it pulls back. It's the only way for it to consolidate after a big move up. It goes sideways, builds a new base, or it pulls back a little bit into support. Now, if the breakout fails, let's say it goes 60, heavy volume goes to 61, the next day it's back to 58 or 57 or 55, guess what? Breakout fails. Lots of breakouts fail. Again, having stops in place, keeping that risk really small is a superpower. Because we're going to be wrong as active traders more than we're right. And that's okay as long as the risk is small when you're wrong. And when you're right, the wins are bigger than the losses. Over time, that becomes a winning formula. Let the winners run and cut those losses small. How you do it, there's an infinite number of ways to do it. You got to find one that works for you. Or what's your time frame? What's your risk? There's all these different variables. But the principles, the concepts are evergreen. These things just last all the time because this is how the markets work. And if it rallies a lot, and then it goes down a little bit, it's just pulling back. All right, look at support. There's a 10-day moving average, a 21-day moving average, a 50-day moving average. Look at prior resistance. You want to see it stay above that, ideally. So it stays above 60. Let's say it goes to 75 and goes there for a few weeks and then pulls back a little bit to 68, 67. All that's fine. You don't want to really see it undercut 60. Sometimes it does. It goes to 62, 63, then it'll roll over a little bit to 58, 59, and then break out again. Those are messy. They happen. I wish it was clean, but that's just how markets work. Asking yourself, how am I going to interact with all of that, and writing down those principles, those rules for you, or guidelines, is another way of creating structure. Finding those breakouts, very powerful. There's a good website, breakoutsandsetups.com, which helps people find breakouts and setups. I just recently launched it. What happens? The idea there, stocks are breaking out. I want to see them. It does most of the work for you. Not all the stocks are perfect breakouts. No. You find the ones that you like. Leave the other ones. And it gives you setups, gives you actionable ideas. Because to me, I was spending so many hours drowning in these charts and looking at this, looking at that, finding breakouts. I'm like, okay, there's got to be a way to automate this. A simple list of stocks and boom. Take the ones I like and leave the rest. Every day, right, in real time. So, or you can find it yourself. Look at stocks moving up on volume and sort those. See which ones are extended. See which ones are trading near prior chart highs. Because what is a prior chart high? What is resistance? What is support? It was an area where investors changed and said, you know what? I'm not going to be buying this anymore. I'm going to start selling it at 60. And then by 50, hey, you know what? I'm going to start buying it again. And they get to 60, now we're going to sell it a little bit. And they do that for 6 months. Now all of a sudden you break above 60 in this hypothetical example, you want to stay above 60. You want prior resistance to become support. Now all of a sudden it gets back towards 60, 61, 60. It's a range. It's not an exact to the penny. It's an area. You want to see bulls show up and defend support, and that new support, which oftentimes could be prior chart highs, or any of the moving averages I mentioned, or uptrend lines, or whatever the case may be. Every situation is different. But the idea is that, again, come up with structure that works for you. How are you going to handle those breakouts? Are you chasing stocks? Are you finding stocks too late? Risk reward. If I enter here, where am I going to exit if I'm wrong? 3 questions I always ask. Where do I enter? Where do I exit? And how much do I risk when I'm wrong? Super, super, super simple and super powerful. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. I want to thank you very much for being here. And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. As always, want to thank you very much for being here. All right, if you missed any part of the show, go to GaryK.com. You can rewind, fast forward, listen at your convenience for free on any device. All right, lots of things. So one, I speak fast. I do it because there's a lot of content, little time. So feel free to rewind, fast forward, take notes when you're seated somewhere. And oftentimes when I listen and someone's going in the zone or in the flow or getting that state of flow, I want to, write down the things that jump out at me. So I definitely recommend people do that. Second, let's finish going here because we have a few more minutes left and then we're going to wrap up. Or I run out of time again. So we spoke about structure, spoke about discipline, spoke about risk and reward, spoke about price, spoke about understanding bases, how markets perform. Bases come in all different shapes and sizes. Some are small, some are long, some are different patterns. There's bullish patterns, there's bearish patterns, but I'm just simplifying it to bases, right? And there's breakouts from those bases. Some breakouts work, some fail, and some just sit there. So that's it. It goes up, down, or sideways. So understanding where you are in that cycle and understand things happen in cycles. There's bull markets, there's bear markets, zooming out, looking at the forest, not just the trees. All this is super, super powerful stuff. But have a way, folks, of creating structure so that works for you. So you can interpret the data that's happening in the market in real time and figure out a way to find actionable ideas. In this business, on traditional Wall Street, there's analysts and there's traders. At the big banks, they're two separate departments. There's literally different job descriptions for people that are analyzing the market and people who actually trade the market. For individual investors, we have to do both jobs ourselves. And nobody tells us they're two separate jobs. So there's, Sigmund Freud had one of his proteges, this guy named Carl Jung. Carl Jung had this theory of archetypes in humans. So he had simplified it to 4 simple things: king, warrior, lover, and magician. So the magician energy is the analyst. The warrior energy is the trader. Right? So I'm not going to go into all of those things. You can Google it if you want, but I just want to simplify it to be like, all right, we have analyst energy, we have trading energy. So the person that's executing the trades that actually has to pull the trigger, it's warrior energy. It's just a good way for me to, when people get it, like, okay, great, I understand that. Magician energy is the analyst. I need to analyze what's happening. I need to look at the market and just sit back, calm, cool, collected, not get too excited, and notice my state. When my state changes, I need to just take some time away, because time heals all wounds just about, especially with trading wounds that are following the principles I outlined for you tonight. To keep those losses small, that's when time can heal the wounds. If you have a 90% loss, it sometimes becomes very traumatizing. Even bigger, 40%, 50%, sometimes it gets very traumatizing. Keep those losses small. It helps with all that. But for the most part, small losses, time heals those wounds. Okay, great. How am I going to engage with the market and separate the analyst hat from the trading hat? So what I do is I look at the markets when markets are closed, also look at it when it's open. For the most part, my analyst role, my big decisions are made in advance. And I learned this from Nicholas Darvis. He was a ballroom dancer decades ago in the 60s and 70s, and even before then, or right around that time frame. And he wrote a great book, How I Made $2 Million Trading Stocks, or in the stock market. And in it, he talked about how he was overseas in Asia. He would send his brokers orders, and he called it Darvis boxes, flat bases. And when it breaks out above the base, he's buying with a stop in case the breakout doesn't work. And he did really, really well. He made $2 million back in the 1960s or 70s, whenever he was around, 50s, somewhere in that time frame. And he came back. Yeah, the name of the book is How I Made $2 Million in the Stock Market by Nicholas Darvis. He came back, was in New York, he was trading with the other brokers, lost it all, just had awful performance because he got caught up in the noise. People's opinions, he didn't have his structure. He wasn't doing what worked for him before. He left, went to Paris, took some time away, his returns came back. And he realized, oh, hold on a second, this is what works for me. And he did the work in advance. If the stock goes above 60, in that hypothetical example, I'm going to buy with a stop at 58 or whatever the case is, right? Okay, great. The trader role, the trader energy, the warrior energy needs to come out and say, okay, here the analyst gave me these instructions. It doesn't have to be done in advance. I'm just telling you what I do because that works for me. And then I need to execute those trades. Now, you can automate them. You could put orders in with a buy stop or a buy limit, whatever they want. Stop loss if this happens, contingency orders. Talk to your broker. I've got nothing to do with that stuff. But the trading aspect of it, lots of times people, again, fear greed. That fear cripples their ability to actually pull the trigger. Warren Buffett has a great line with fear and greed. He goes, you want to be greedy when others are fearful and fearful when others are greedy. Meaning, if you buy a stock at 10 and it goes to 9, lots of people get greedy and say, oh, I'm going to sell it when it gets back to 10. He says, no, be fearful, because it can go to 5 or go to 0. And the opposite is also true. You buy it at 10, it goes to 11, I'm going to sell it because I'm fearful I'm going to lose my profits. Now, that's when you want to be greedy. Let it run. So it's not just Buffett. It's collective wisdom. Be fearful when others are greedy, greedy when others are fearful. Again, just taking yourself out of the equation. Something called a personal blind spot bias. We can't see ourselves objectively, right? It's real easy to see other people, flaws in them or strengths in them, but seeing ourselves, not so much. But it's a superpower. Think of 100 newlyweds the night of their weddings. How many can get divorced? No one's going to raise their hand, but we know statistically half of them are getting divorced. That's an example of the personal blind spot bias, right? Being able to take yourself out of the equation and realize, like Ray Dalio says, it's another one of those. Ray Dalio is one of the biggest hedge fund managers ever, and he wrote a book. It's called Principles. In it, he says, hey, look at things objectively. It's another one of those. This event has occurred before. You might not have experienced it, but it's happened before. Study it. Study history so you don't repeat it. Again, having the structure in place, the discipline in place to think in advance about how you're going to handle risk and reward, where you enter, where you exit, how much you risk when you're wrong, all of these things really, really give you a big edge, opposed to the person who just wings it. Maybe you want to look at the market 10 o'clock to 11 o'clock every day, or 3 to 4, or 5 to 6, or 8 to 9, whatever works for you. But figure out a way to get out of your head, get your thoughts on, and I like to write it down, but whatever works, and then separate the analyst role from the trader role, and being able to pull the trigger when the time is right, when the criteria, you don't have to buy breakouts, you can buy any way you want. It's the other beauty of this thing. There's no rules. As long as it's legal and ethical, that works for me. Find out what works for you. And then be able to do it, pull the trigger when it actually comes time and that criteria lines up. Hope this is helpful. These are some of the principles that I live by and I share with other people. There's some more that I'll cover later in the week and at other points in time on the show. But as always, I want to thank you very much for being here. It's really a pleasure to share this with you. This is the one and only Investor's Edge.